Welcome to Many Happy Returns, where we aim to make you a better investor. The US has captured Venezuela's president, the White House is openly threatening to invade a NATO ally, and the Fed chair is under politically motivated criminal investigation. Apart from that, everything's fine.
But should you actually change anything about your portfolio? Or is carrying on as normal always the answer? And in today's dumb question of the week, is any asset risk-free? All right, let's get into it. So yesterday, Romin, you and I went for lunch, which was rather nice. And you ordered for dessert an apple pie, as American as it gets. And as it turned up, unexpectedly, they decided to set it on fire in front of you, didn't they? Is this an omen?
Oh, I'll just never forget your daughter's eyes widening as she saw the flames pouring over my pudding.
Why can't I have cognac on my dessert, she thought.
Yeah, and before we start this, I should say that I spent a lot of happy years in the United States. I used to go out there for holidays. We lived in California for a while, and it was just a lovely place. And my aunt and uncle live there, so I've got family out there. So it's definitely got a tender place in my affections. So just seeing what's going on right now is a bit worrying.
Yeah, and the immediate context for this is we both woke up this morning on Monday, the 12th of January, and saw that Jerome Powell, everyone's favourite Fed chair, is now under criminal investigation. What do you make of that?
Yeah, I think so far what we've seen is that he's been pushing back, holding back what he said, and generally not trying to rock the boat. He's saying, well, I'm just getting on with my knitting, and if there are crazy statements coming out of the White House, then I'll just brush it off. Not so today, because on the FOMC's website, there's the full transcript of what he said. On their YouTube channel, the very short video, which is just a couple of minutes long, definitely worth watching, he lays it all out. And he says, and I think I can quote from this, "I have deep respect for the rule of law and for accountability in our democracy. No one's above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure." So absolutely clear. This is not about my testimony last June or about the renovation of the Federal Reserve buildings. It's not about Congress's oversight role. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation.
It feels like he made the best attempt he could to get along with the White House, despite Trump, calling for interest rates to be cut to 1% at one point. But now that's gone out the window, right? If you're being investigated by the Department of Justice, allegedly for not being transparent with Congress about the overspend on the renovation of the Fed's buildings, but I'm not sure anyone quite believes that. But the question really is, why now? Powell's term as chair is due to end in May, just a few months away. It's not quite clear what the administration's trying to achieve.
Yeah, is this a hill they want to die on? Because this will cause market disruption, particularly if what follows this is a Fed chair who doesn't do what the usual Fed chair does, which is to change their behavior when they hit the seat. Okay, Powell's appointed by Trump, so in theory, he could have been Trump's guy. He could have just responded to threats by the president or just suggestions by the president as to what should happen for monetary policy. But that's not what happened. People transform when they enter the building, and they base their decisions based on economic data, not on what's politically expedient.
But Powell is basically a Fed lifer, right? He's been there a long time. He's served under 4 administrations. The next Fed chair might not be that. It could be an external person who comes in with their own ideas about how it's appropriate to set monetary policy.
Maybe they could make the case that it's more powerful if monetary policy and fiscal policy work hand in hand. I think there is an argument to be made for that, and maybe that's the way to sell this. But the way I see it happening is that that will not be the way they sell it. It'll be pretty clear, whoever it is, that they are going to do what the president wants. And they don't feel that they have to justify it. That certainly seems to be in line with the other changes which we've seen in the way that policy is run right now.
The complication here, of course, is that as powerful as the Fed chair is, they don't set interest rates on their own. It's decided by committee, the Federal Open Markets Committee, of which the chair has one vote. Now, maybe what's going on here below the surface is we said Powell's term ends in May, but his term as governor, able to vote on the board, would actually run until 2028 unless he stepped away. So maybe what Trump is trying to do is to force Powell out, like get him to resign so it frees up another seat which they can fill. Obviously, they're also trying to fire Lisa Cook, another governor in the background. And if they get Powell out and they get Lisa Cook out, then those 2 additional seats, along with the ones they've already filled, would probably give them a majority on the board and the ability to set monetary policy as they wish.
I think that's a possibility. I think that could be part of the larger goals. But markets will not like this. They don't want the entity which is supposed to control US inflation to be dominated by political forces. This separation of what the Fed does, monetary policy from fiscal policy, is seen as a good thing. Except for the inflation spike that we saw post-COVID, it's certainly done a good job of keeping inflation under check. And of course, politicians want to offer bread and circuses. They want to stimulate the economy, they want tax cuts, they want to have an economy that's on fire, and they want to get re-elected. But that's not always in the best economic interest of a country because of inflation.
They're offering plenty of circuses at the moment, whether the bread's there. Well, the bread's there, it's just expensive, right? But you mentioned the market reaction. That seems to have been muted so far. There's been a very slight dip in the stock market this morning, less than a percentage point. Gold has jumped a little bit, but nothing extreme at all yet. Obviously, this is the initial reaction. We've only just heard this news as we record this. But it doesn't seem to have been enough to push markets into panic.
Yeah, I think a lot of this stuff happens slowly then quickly. For example, what we've seen is outflows from asset managers across the world from US equity. Now that is unusual, certainly given the pattern of what we've seen over the last few years. I think a lot of the stability of the S&P 500 has been that it's held up by the Magnificent Seven, and that's justified by their incredible earnings growth. So part of it's euphoria, but a large part of it is that their profit growth has just been stupendous. And yet, if you actually look at what the earnings forecasts are for the next couple of years, the S&P 500 will no longer be fundamentally held up by those 7 stocks. What markets are expecting, if you look at broker forecasts, is a widening of the support for the S&P 500. So lots of capex spending by the Mag 7 for AI, and that's going to erode their earnings growth, and a widening out into other boring sectors like healthcare, which is expected to grow by over 10% earnings growth, I think, in 2026. So the question is, will that hold up? Will the rest of the S&P's widening support for the fundamentals of the US market hold up the market when we've got these proclamations coming out of the White House, which are rocking the boat? And we've got outflows from international investors. And we've got the geopolitical instability that comes with the decisions which have been made so far. So I think it's a combination of these factors that build up to a critical mass that makes markets suddenly go, oh, wait a minute, there's something deeply wrong here.
And the question over the Fed is only going to get ramped up, I think, over the coming weeks and months. So the Lisa Cook case is going to be heard at the Supreme Court in less than 10 days, I think. We've also got that question hanging over everything about who's going to be the next Fed chair and how are they actually going to be confirmed? Because I saw that even Republican senators who sit on the committee that oversees the Fed, so for example, Tom Tillis, who's a Republican senator from North Carolina, he says he will oppose any Fed nomination until this legal matter is resolved.
Yeah, there's a brilliant quote from him in the FT where he says, if there were any remaining doubt whether advisors within the Trump administration are actively pushing to end the independence of the Federal Reserve, there should now be none.
So I guess we could have a situation where there's a standoff between the Trump administration and Congress over who's running the Fed. That's the kind of uncertainty which could unsettle markets.
But even once someone's confirmed, it's possible that they will push back on pressure from the president or not. And it might be helpful to think of some examples where it did go wrong. Now, the classic example of that is Fed Chair Arthur Burns, This was the 1970s, so few people listening, I suspect, are going to remember this. But his Fed chairmanship led to this overly loose policy, and that meant that we had this inflation surge in the 70s, partly because of the Fed policy.
And the Fed wasn't setting policy in isolation, really, at the time, was it? This was, again, an activist White House, if you want to think of it in that way.
Yeah, so Nixon knew that his chances of re-election would be greater if there was a lower interest rate and credit was cheap, and that caused economic growth. But if you listen to the Oval Office tapes, which was the huge scandal of the 70s, which eventually led to Nixon's removal as president, or resignation eventually, it was clear that he was repeatedly pushing Burns to ease policy ahead of this 1972 election. And he made it really clear that he wanted rapid economic growth, low unemployment, and that was much more important to him than price stability, even if that wasn't more valuable to Americans. So in 71 and 72, the Fed held rates artificially low, lower than they probably should have, and allowed really rapid monetary growth, even though inflation was already elevated. Now, that did deliver this really strong pre-election boom, but that created this inflationary pressure that followed.
How bad did it get?
So initially not too bad. Inflation was 3 to 4% in 71, 72, and they had wage price controls in place. But then it jumped to almost 10% in 1973, 11.8% in 1974. So pretty bad.
And it wasn't a one-off either. It happened again in the 70s later on, didn't it?
Yeah, and it's worth mentioning that it came hand in hand with supply shocks for oil and the breakdown of Bretton Woods. So it wasn't just about Fed policy, but people think it certainly played a role. These things never happen in isolation.
And I guess for a more recent example, people would point to a country like Turkey, where Erdogan has influenced monetary policy and they've suffered very high inflation as a result.
Yeah, so this happened from 2018 onwards, and we already had high inflation in Turkey before this happened, but the unconventional decision by Erdogan was that instead of keeping interest rates high, he thought that it would be a good idea to lower interest rates. There are various reasons people put forward for this. Some people say it was because it was his son-in-law who suggested that this would be a good idea, and then he overrode what the central bank presidents and staff were suggesting, which is the conventional idea that high interest rates would be better. The result was that he just fired central bank presidents repeatedly if they disagreed with him, and eventually they started agreeing with him, and then the central bank repeatedly cut or held down policy rates despite inflation surging ever higher. So that created deeply negative real interest rates, currency instability, price instability, and it was a disaster. And eventually Erdogan chickened out. So the consequence of all of that was that inflation spiked to around the mid 80%, right? So this is not like your 10% inflation shock. This is really difficult to live with for the society as a whole. And the result of this inaction led to a really strong reaction, which is that they had to raise the policy rate to around 50% by 2024. And it did start to work. Inflation eased and the currency stabilized. So I think that's the consequence. If there is a period of inaction from the central bank, it then has to overreact in order to get the ship back on an even keel.
50% interest rate, Roman. Surely we're not going there in the US. Could this play out? Is this all just people panic about nothing? Yeah, Trump might get a say over monetary policy, but the difference between, a 3% interest rate and a 1.5% interest rate is not catastrophic. Or could it be?
Well, you say 50% interest rates in the US could never happen. Remember, the consequence of all of this stuff with Burns was that Paul Volcker, took over as Fed chair from 79, and he had to raise US interest rates to around 20% in 1980 to 81. So not 50%, but still not pleasant.
So you think it is a real risk then? And if that's true, why aren't markets worried?
I think it is a real risk. I think that markets, equity markets at least, always see a glass that's half full. That's why I think the place to look is at bond markets, because there I think it's more likely that we're going to see a bit of a shakeout. And remember what happened previously, which is that when there was a Treasury market sell-off, Scott Bessent, I think, probably fed back to the president that this was really a big problem. And this was to do with the tariffs, of course. So maybe we'll see that feedback loop kick in again if the Treasury market does seem to show signs of instability.
Hasn't yet. The bond vigilantes are sitting on their hands for the moment.
Look, markets haven't opened yet, and we've only had the announcement on Sunday evening is when Powell published his speech.
And I guess you mentioned earlier that the 1970s inflation episode didn't happen in isolation. It wasn't just the Fed. There was supply shocks in the energy market, the oil embargo. And it's not happening in isolation this time either. I think it's not that controversial to say the rules-based international order is weakening. There are huge geopolitical questions around the world. Like we just saw the US do something extraordinary in Venezuela, capturing the president and basically taking control of Venezuela's oil industry. And there are all these questions over Greenland, with Trump basically saying, we are going to do something here. And I think we should probably believe him. I don't know. It kind of feels like this time could be different. Dangerous words, but that's what it feels like.
And this is 1 year into the presidency, right? Remember that. This is just the beginning, really, of the changes that we've seen. And this is likely to continue for another 2 years because there's nothing to hold this back. It's very clear that the checks and balances that you normally see in the US are just not operating. We have seen some of the decisions being quashed in the Supreme Court, but it seems as if, for now, whatever institutional guardrails were there have pretty much disappeared.
And we have got a ruling due any time now, really, on the legality of Trump's reciprocal tariffs. The betting markets seem to think he's most likely to lose that ruling, and the tariffs will be ruled, at least in part, to be illegal. And then there's a question of, will the government have to refund all these importers who've paid tariffs? And I don't expect the White House to take that lying down, were they to lose a Supreme Court battle. Or the other way, if the Supreme Court rules that these tariffs are fine, despite the fact that they're kind of unprecedented and you can't really say they're fine or there's an emergency going on which justifies them, wouldn't that just show that, again, the Supreme Court is now not going to stand up to the White House? And if they're not going to uphold the rules, then who is?
Yeah, and I think what we've seen is that the world has moved away from a world in which things were just agreed by a kind of conventional view of things to one in which might is right. And each country is going to grab the resources that they think they can get away with. Because I think the other point, and an important one, is that the US has now set a precedent, which is that if you've got the firepower, then within your local sphere of influence, you can grab whatever you want. And so China's probably looking at this and thinking, well, why wouldn't I invade Taiwan?
Well, I can give them a few reasons, but maybe they are thinking in that way. But we're saying, why haven't markets reacted in a big way? Despite the fact that you can quite easily map out a path to a complete unraveling here of geopolitics. I guess the ones that would really, really move the needle immediately would be Taiwan, because that country is so important for the chips that underpin the AI trade. Something like 90% of those high-end chips are made in Taiwan. And all the analysis I've seen about their plans for resisting any sort of Chinese aggression involve blowing up those chip factories themselves. So like scorched earth, not going to be good for the Magnificent Seven trade. The other one, of course, is Greenland. Like if the US moved to annex Greenland or something like that, presumably that blows up NATO and changes everything, right? Who knows what happens there? And then, of course, Ukraine. You can't rule out a disastrous further escalation there either.
So let's just recap on Greenland, what has actually been said and what the consequences might be. So Trump, possibly understandably, says that Greenland is important for US security. If you look at a map of the world, you can see that that's what lies between Russia and North America. It's like a buffer state, for example.
It looks weirdly big on the maps, doesn't it? Because of the way it skews the Arctic regions to be massive. It looks like, wow, there's this huge country there. How has Denmark got that?
But then you look at Google Earth and you realize, oh, that's just the Mercator projection, which is making it look big. Yeah, maybe some people have said actually that Trump should look at a different version of the map.
But it is important, right? Because as climate change progresses, as people expect it to, Arctic Sea shipping lanes open up, which are like 40% quicker than going by other routes. There's also huge natural resources, supposedly in Greenland, which become more economically viable to extract as ice starts to melt. And Trump's view is, why should Denmark get all of that benefit just because it landed a boat there 500 years ago? I think was his quote, not realizing the history of America's founding, I presume.
But you just look at what Danish officials are saying. They do take it absolutely deadly seriously. So, for example, the Danish Prime Minister, Frederiksen, has said that if there is an attack on Greenland, which is one of the ways in which the US has said it could take over Greenland, the White House actually said utilizing the US military is always an option at the Commander-in-Chief's disposal. Well, I think you can understand why the Danish Prime Minister said that this could mean the end of NATO.
Which really would upend the entire global order. But he's right, though. You can't have NATO allies invading each other. Hopefully it doesn't get anywhere close to that, but the rhetoric's there. It seems that Trump wants to make a deal, right, and sort of buy everyone off. But the Greenlanders themselves sort of don't want to be Danish or American, as far as I can tell. Not that there's many of them there.
And the Polish Prime Minister, Tusk, has warned that NATO would lose its meaning if one member attacked another, which is absolutely true.
Do we want to think through what happens to the world and what happens to investments if that happens, if NATO just sort of disbands or at least some members leave? Presumably, countries in Europe just seize US bases on European soil. Presumably, America's allies as they exist at the moment decide to free themselves of any reliance on America financially and militarily as quickly as they can. But at the moment, those reliances are deep.
I don't think Europe could do that. I just think economically we're so dependent on the US for our tech, for our payment systems, that it would just be impossible to pull the plug on that relationship. So what we'll probably move to is what happened before NATO, which was just informal agreements that, yeah, if you get attacked, we might do something, we might not, depending on whether it's in our interests.
Presumably, this all goes hand in hand with a massive risk-off move across global markets.
Oh, yeah. I think that would be a given. And I think in Europe in particular, where the threat from Russia is a real one, well, that suddenly becomes a much bigger threat.
So bullish for arms manufacturers, perhaps, but pretty bearish for most other assets, except maybe gold, I guess?
Yeah, for anything which is going to be seen as a safe haven, which now doesn't include the dollar, that would provide upward momentum. So I'm thinking here about gold. I'm thinking about things like government bonds, local government bonds, not US government bonds if you're based in Europe. And I think a realignment of what a lot of money's been spent on until recently. So we'll go back to individual countries having to spend more of their GDP on defense. We're already seeing that. And a shift from, I think, tech to a much more materials-based and industrial-based policy when it comes to growth.
The peace dividend would be over. Perhaps it's already over when we're seeing what countries in Europe are now having to pledge towards defense spending. But the question with all these kind of tail risks is, how likely is it to happen? Let's look at the Greenland question. I've gone on Polymarket. So what does the betting market think about what's going to happen to Greenland? So here we go. Will Trump acquire Greenland before 2027? 16% is what the market thinks is the chance of that. Will the US acquire part of Greenland this year in 2026? 25% chance of that, Roman.
Wow.
It doesn't necessarily mean it's an invasion, but, will some sort of deal be struck? But here we go. Will the US invade Greenland in 2026? 9% chance. That's a pretty chunky tail risk for blowing up the world order.
But the question is, are they going to pay out on this? You've got to be really careful with the wording on Polymarket, haven't you? There was a bit of kerfuffle recently about the invasion of Venezuela.
Yeah, so if you'd bet on the US invading Venezuela by the end of January, you'd have thought, wow, I'm quids in now with all those helicopters flying over Venezuela's soil. But no, that was determined to have not happened. It wasn't an invasion. But if you'd bet on US forces in Venezuela by the end of January, you would have been paid out. So yeah, check the fine print if you're in the mood to be placing bets on the end of the world. But interestingly, going back to Polymarket now, if we look at will NATO dissolve before the end of 2027, that's given the exact same odds, 9%, as will the US invade Greenland, which I guess tells you what would happen were the US to invade Greenland.
Yeah, I don't think that's a coincidence, those two odds being the same.
But let's just step back here, Roman. If we believe these are the odds, so you've got a roughly 10% chance that the Western alliance, at least the military alliance, collapses, a 10% chance of that within the next couple of years, how should you respond? Because, that doesn't happen in isolation. That has consequences in markets, obviously. Is there a case for going risk off with your portfolio now? I know you've gone a little bit more risk off, but not for this reason.
Yeah, I just had a really good run with my 100% equity allocation, and I've now got enough. So for me, it was more a matter of not needing the risk. I'm kind of glad that it happened with this backdrop. But I think what you're saying is really interesting. Is it the case that you can buy an index fund and just forget about it now, a global index fund for equity, and not worry? And I think the answer was always no. I think whether there's a NATO alliance, whether there isn't, there's always been issues which make people worry about the equity market. That happened before the Second World War, it happened before the First World War. But I think if I had to kind of summarize it, we've moved from a world in which essentially stability was enforced by institutions to ones where it isn't. And I think that probably means more volatility. Obviously, there'll be more volatility in the first instance as we adjust to this new world and we see the immediate consequences. But longer term, I think we're in a world where there can be more accidents, where there can be more wars, where countries are more likely to have a go at a land grab or a resource grab than they were previously.
I guess the way I look at it, as someone heavily exposed to the equity market, is that I've steeled myself for the fact that the normal course of events mean we're going to have 50% sell-offs now and again. People say it's once in a generation. However frequently it is. In my lifetime, we've had the dot-com bubble, which was 50% down for the S&P. We've had the global financial crisis, which was around 50% down for the S&P, a little bit more. I can live with that. It sounds weird, but I can live with that. That's the price of holding equity. However, if we were potentially in store for a 90% drawdown, more like a Great Depression style peak to trough fall, cataclysmic, then that's more than I could stomach, right? So I don't know how plausible that is. We always say don't allocate for tail risks. But when we're talking about 10%, that's getting to the point, I think, where you have to start to think about it. It's been a luxury that we haven't had to care about geopolitics too much in my lifetime. That's definitely changed now. But I can't make out quite what would happen were the worst to happen. Like what would happen in markets were the worst instincts of world leaders to play out.
I think here there are some precedents which we can look at, for example, the Second World War. And of course, during the Second World War, the markets had to shut and there was a huge amount of volatility, particularly for countries which lost the war. And for those markets, it was catastrophic. For the winners, however, ultimately, it led to pretty strong returns. So I know this sounds cynical and awful, but in a way, if you are globally allocated, you will be buying the winners and the losers. If there's still free movement of capital, that's the big assumption. And that's also something which we've grown used to, which is that you can buy a global index fund and buy everything. Well, that might no longer be true. So we might be moving into a world in which only if you're in the right place inside it would you be able to invest in those winning countries. Part of the cost of being on the losing side would be that you'd be locked out of those successful capital markets.
So you got to back the winners. Okay. Sell your Greenland stocks, is it, right now? I think. I don't want to live in this world, Romin. Why can't we sort of vote on what world we want to live in?
Yeah, unfortunately, that's not the way it works. Democracy is still pretty local, but I wouldn't be too downbeat about this because longer term, ultimately, democracy is still there in large parts of the world, and some of these things will be self-stabilizing. If people live in a world where things are obviously worse than they were in the past, then hopefully they'll steer things back towards a more stable system. My worry is that that's not going to happen, that there will be a greater demand for strong men, for authoritarian regimes, with the mistaken belief that that's going to stabilize things. Whereas in fact, these authoritarian leaders thrive on chaos because it increases the demand for them.
And there's also a weird possibility that despite a lot of these moves being unsettling, they kind of reinforce corporate earnings somehow. Like you bring more Venezuelan oil supply online, pushes the oil price down. That's kind of like a monetary easing almost around the world. If Europe just sort of decides, you know what, we can't stand up to the US, we better become more like the US. Well, the US is the successful country in terms of capital, right? So maybe that's good for markets. Like, who knows? You can't just go, the world's going to change, therefore everything's going to go bad.
I agree. I think you should always consider the possibility that you're wrong and that these other people are correct. And you're right, the US has been so successful in the past. However, not necessarily successful because of these kind of policies. They have gone wrong in the US in the past. And they've certainly gone wrong elsewhere in the past. So, for example, erosion of central bank independence and oversight of power by stabilizing checks and balances and by economic watchdogs.
I guess the traditional view from market watchers around geopolitics is that this is noise, right? Traditionally, this is noise. Unless it affects earnings or interest rates or liquidity, you can ignore it. Things will go up and down in the short term, in the long term, it will be fine. That was always my view. Being a child of the 80s, growing up in the 90s, end of history, all of that, we're all good. Yeah. That's no longer my view. At the very least, this is going to change the discount rate. If Fed independence is compromised, the risk-free rate isn't risk-free, but we'll come on to that in the dumb question. But for sure, uncertainty is much higher than it was, I think. Like those tail risks have become fat tails now. But I'm undecided on my portfolio. My instinct is just keep it the same as ever.
Yeah, I'm not changing anything. And fortunately, I did really enjoy that apple pie.
The flames actually added to it, didn't they? It made it a sort of spectacular event rather than just a dessert.
Yeah, maybe that's an omen. If you're feeling stressed by these events and you want to discuss that with like-minded people, then you can do that as part of our community. Just go to our website, pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. Is any asset risk-free?
Now, as always with finance, some of these phrases that people use are misinterpreted, perhaps justifiably. But I bandy about the word risk-free all the time, and I get pushback on it. So Laura always says, when you say that, it always happens that we get these comments and they're saying it's not risk-free. So I think it pays to actually say what we mean by it. Of course, it's true that there is no risk-free asset. There is no such thing. Everything comes with risks. But of course, the risks vary, sometimes by orders of magnitude. But certainly financial theory depends on this definition of a risk-free asset. So maybe that's why we talk about it so frequently. When it comes to pricing, it's really important because that allows you to say, for this set of cash flows in the future, where does it sit relative to that risk-free asset? What is its risk premium? How much additional return does it give you over that risk-free rate?
I find the concept of the risk-free rate really interesting. I remember listening to a lecture by Ashwath Damodaran where he said, yes, it is a mistake to think that government bonds are risk-free. We use it as a proxy for the risk-free rate. So if we're doing a cash flow model and we need a risk-free rate, we might stick in the 10-year treasury yield or something like that. That is not actually the risk-free rate, but there is a theoretical risk-free rate. It's just not exactly what the government bond yield is. He says even in an emerging market where clearly the government bonds are not risk-free, that country and currency still has a risk-free rate. It's just a lot harder to work it out and it involves a lot of estimation.
But just to explain the intuition behind it and why it's important, let's say that you could invest risk-free at a rate of 5%. Well, that tells you immediately that if you're taking risk with something else, which does have a risk, then you should receive an income which is greater than that risk-free rate. So it sets a floor, I think, on returns for things which are risky. And the additional return you receive for those things increases as you take more risk above that risk-free rate. So that's why theoretically it's just so attractive and so important.
So what would a risk-free asset be? It would presumably be an asset which pays a guaranteed return, no questions asked, and has absolutely zero chance of default. Those cash flows are 100% guaranteed.
And it's a question of liquidity. There's got to be complete liquidity. You can buy and sell this thing at the drop of a hat, and there's no huge trading cost to do that. So that's a really important part of it too. Now, as you say, no such thing exists. We've got very close proxies, very close, but nothing which is exactly like that.
I guess with a government bond, you are guaranteed, almost guaranteed with the developed market to get your money back, especially if they control their own currency. They could just print the money and give it to you, right? There's no one stopping them doing that. But there are other risks there, aren't there? There's inflation, there's interest rate risk.
And to some extent, liquidity risk. It isn't the case that you can frictionlessly buy and sell short-term government debt in unlimited sizes. That's certainly not true. And in market dislocations, that trading costs and some temporary discounts could get substantial. But is that almost risk-free? Yeah. And the shorter term the bonds, the closer to it that you get. Now, in order to be truly risk-free, if you're parking your capital in an investment, it has to match inflation. So I guess what you'd have to say is that it's a real risk-free rate. Now, for a nominal government bond, that's not true. For an inflation-linked government bond, it's kind of true. But even then, you've got risks like switching from one inflation index to another, which we're going to get in the UK. You've got questions about the publication of the RPI index and then the CPI index, how accurate it is, and whether it reflects your rate of inflation. So there are always questions around whether things are truly risk-free.
Except for Bitcoin. 1 Bitcoin equals 1 Bitcoin, doesn't it, Robin? You've got to remember that. Isn't that what they say?
Oh, yeah,
1 Bitcoin equals 1 Bitcoin.
Yeah, I mean, everything is on a spectrum, and I've got to say, cryptocurrency is way out there on the extremely risky end of the spectrum, which is why what you said is amusing.
Thank you for reviewing the joke. Good night, everyone. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.